Hello and welcome to the latest market update with me, Andrew Dawkins, and
myself, Daniel Bajwoluk. How are you, Andrew? Good to see you again this month.
I'm very well, Dan. Yeah, it's been a good July, I think, all around with the massive heat.
Yes, heat wave. We mentioned the potential heat wave that we were hoping we were going to get, and then it happened as soon as we finished filming, I believe. The heat came out. So hello, thank you for calling for me.
It was a mighty good 2 days.
It was.
Yes,
so what else has happened in July, Andrew? We've got some good news for our clients regarding A.R.D. Consultancy portfolio funds.
Yes, I think for the first time in a long while, we can say it was a very positive month, and I think we've been scratching away for the last 2 or 3 months, saying, well, if we can get 0.1 of a growth in a month, we'll be doing well. Well, this time we got sort of 5, 6, and 7% growth over the month of July, and the reason for that.
Tell me.
Yeah, exactly. The fundamentals still remain, and inflation continued to escalate, especially in Europe, the UK, and America. And yet the markets just sort of said, right, well, okay, actually, we're not doing too badly, because there were some big companies reporting figures and numbers. And I think out of the S&P 500 in America, something like 75% of earnings reported were above expectations. So it gave the market a boost. But it really just goes to show that really what we've been saying over the last few months is behind it all, in that there's too much demand and too little supply. And that, finally, I think the markets have taken notice of that it isn't anything fundamentally bad within the world. It's just that there is a lot of money there from savings that we've had to make during the COVID period, and we need to start spending again, and we are doing so. Actually, consumer spending is up, which has driven everything else sort of positive.
Okay, so what about our good friend fixed interest then?
Well, for the first time in a long time, we've had a positive run in the fixed interest funds. Fixed interest is just a couple of posh words for lending money to governments or lending money to companies. And I think what's happened here is that for the last few months, certainly since around about October time of last year, a lot of the fixed interest funds have been selling off assets which weren't likely to keep pace with inflation, or that were going to underperform. And so a lot of those assets have been sold off to be replaced by assets that hopefully will weather the storms a bit better. And I think we can see then this month has delivered positive returns for the first time in a long time for the fixed interest sector. So all showing good, healthy gains over the month. And it's the repositioning of bank base rates. So in the US, rates went up by 0.75%. They went up here in the UK. And for the first time in over a decade, the ECB put up base rates there. So all adding to the effect that if interest rates go up, it means that people have less money to spend, and therefore inflation comes down. But in reality, it doesn't actually work that way. It really hits the people that are hardest affected by the cost of living increases. Because if you're putting up somebody's debt, then proportionately those people that are less well off, it takes up a bigger percentage of their income. So we can see Walmart, for example, one of the biggest retailers in the world, has said that they're noticing now down turn in supply demand in America in particular, as people at the lower end of the pay scales are cutting back and sort of cutting back quite dramatically. So it's probably hitting the wrong people, where rate increases put people off, but probably put people off that are least affected by the economy generally, in terms of the more affluent people. A rise in interest rates really doesn't affect in the same way as it does for people at the lower end. So it's very, very difficult for some. But fundamentally, raising interest rates doesn't necessarily kill inflation. It's trying to get supply back. That's what we need. We need the supply chain to be back to full capacity.
Similar to the Walmart story, I've heard that Greg's starting to sell more sausage rolls now more and more people are coming to get their sausage rolls because they've got less money.
Ah,
There you go. I read that this morning.
very good. So the vegan sausage rolls?
It will be. It will be.
Very good. Good. Other sausage rolls are available from
Yes.
other manufacturers, suppliers.
Okay, so we've talked a bit about fixed interest. So how did the equity markets perform?
So equity's been very, very good. Big rebound in confidence in America. All the major indices are up, especially the tech stock. Microsoft reported really good earnings this year, as did Alphabet. And really looking on the sort of positive side, that there's good consumer demand, good margins to be made, and the supply is coming back up to speed. The other one was that Google reported increased advertising revenue, which confounded a lot of critics, because people were thinking, well, companies will start cutting back in advertising as fears of a recession loom. And interestingly, America did go into recession, as we understand by the definition. They had 2 negative quarters in a row, which means that they're in what they call technical recession, because they've got other ways of measuring recession, apparently, although nobody really knows how they actually do it. It's a big secret, but they'll probably tell us in a few months' time, by which time everybody will have forgotten that anyway. But it's the Americans, bless. In the UK, the actual output for the UK surprisingly jumped, surprisingly for the doom mongers out there. So the UK economy grew by 0.5%, which confounded critics. In Europe, there's some really good numbers. Probably the only area really of worry is that the German economy is still flat. And of course, they're hit hard by the reliance on gas, in particular from Russia. But other than that, Europe did really, really well. So earnings from most of the companies that have been reported so far are up this period. So really good demand stories out there. And again, it's just the supply chain trying to catch up with things. The banks had a very, very good quarter. And with interest rates going up, it makes things a little bit more profitable for banks. So they'll be doing special deals. You'll be getting 0% interest credit cards. And a lot more of those offers will be back on the table. Probably long-term loan rates will start to fall as profits start to come in for the banks. So it was a really good period. And over in the Far East as well, the market there is relatively strong. So some good figures coming in. And all indicative really of the fact that the economies generally are in good shape. But as we keep going on, as people keep talking about recession, then that's what you'll end up getting. And it's just this confidence factor. Nobody can define that as to when markets go up and down. You always look for that reason, and it can just simply be if you've got confidence in the markets, you'll back it, and if you're not, you'll just come away. So long term, the outlook remains positive.
And it really has been what you've been saying over the last few months, hasn't it, Andrew? You're sort of predicting the fact that, well, you don't know when the markets could go up. They could go up tomorrow. They could go up next month, and like you're saying here, there's no rhyme or reason, but it has come back.
Yes, that's it. It's just that missing something, which nobody can really put their finger on, because when you think of it, if the US economy has contracted for 2 quarters in a row and is in recession, you'd be expecting that there'd be a lot of people now being made unemployed. The job centres will be busier than they've ever been, but it's actually the opposite. There's more people in employment than there's ever been in the history of the world, which is incredible. Here in the UK, we've got almost full employment as well. There aren't people being laid off. So it's confounding a lot of these so-called experts. But the facts are that we've just got more money in the world than we've had before. And we've never had the financial effects of a pandemic like this, ever.
Andrew, why don't we finish off by discussing the outlook and what you think it'll look like going forward with everything and the markets?
Yeah, so short term, who knows? Because on the back of continuing gloom and doom, some people say that the markets had a spectacular July. So presumably, if we get good news in August, we'll probably go back 3 or 4%. Who knows? It's a crazy world we live in. The fundamentals remain. The economies in most places are strong. The banks have more money on their books than they had going into the financial crisis, for example. They're well capitalized. People generally have less debt than they did years ago. Unemployment continues to be low, not only here in the UK, but in America and in most of Europe. Looking further to the Far East, then there's good signs of growth there, a wealthy population that's wanting to buy a lot of products and services. So it maintains good. The fixed interest, as long as inflation's high, interest rates are high, that may start to come good again. But again, we'll be very susceptible to inflation then falling quickly, or if interest rates start to drop. So fixed interest could take a wee while just to settle down. So I wouldn't be encouraging anybody just at the moment to sort of switch from equities to fixed interest necessarily. Long term, though, the outlook is very, very good, as we can see with the numbers that we put up on our charts each month, that we're interested in making money over a longer time period rather than speculating and trying to guess what markets are going to do, because we leave that to other people. And if we can concentrate on the bricks and mortars, which is choosing funds that are good pedigree funds that keep performing well year after year and have assets in that we understand and we can identify with, then I think we'll do well, and therefore our clients will do well as a consequence.
As we do every month, Andrew, why don't we go through the A.R.D. Consultancy portfolio of funds, through defensive all the way through to aggressive. And we'll do 1 month, 1 year, 3 year, and 5 year. So we'll start with defensive, Andrew.
Okay, so defensive over this month up 3.6%, over the year down 8%, over 3 years down 0.2%, and over 5 years up 11%. The cautious portfolio for this month up 4.4%, year to date down 7%, over 3 years up 3.6%, and over 5 years up 19%. Our balanced portfolio this month is up 5%, over the year down 4%, 3 years we're up 8.6%, and over the last 5 years up 28%. Then our capital growth portfolio this month up 5.8%, over the year to date 6.8% down, over 3 years up 13.7%, and over 5 years 38% growth. And finally, the aggressive portfolio this month we're up 6.4%, over the last 1 year down 5.4%, over the last 3 years up 19.2%, and over 5 years, a nice round 50%.